First to today's closing bell exchange, Danielle Hughes from Divine Capital, Don Schreiber from WBI Funds is with us, Lee Munson from Portfolio Asset Management, and our own Rick Santelli. Lee Munson, even at these levels, you still feel we are in a sweet spot for investing in equities. Why?
Well, number one is that investors never want to invest when unemployment is high or when the PE ratios are low. So right now, we still have a good level of high unemployment, which would bode well for the out years of investing as well as valuations. So the sweet spot, Bill, is that the public feels things are really getting better when really all that's happening is that the valuations are still good. So I want to encourage everybody to believe the lie that we're really making a lot of new jobs and invest their money accordingly.
Oh, he's so cynical, Danny.
Well, you know, it is true.
Compassionate cynicism.
Yeah, it is true that, you know, investors really haven't believed the hype yet. They're not here. They haven't been coming. We haven't seen the great turnover that we've expected to see. And who knows if they're going to join the party now or if the party really hasn't started yet. We don't even know. But investors have taken out $556 billion since 2007, and we really haven't seen any of that come in until January when we started seeing money come back into ETFs and mutual funds. But that's where they're coming back in. They're not jumping into the stock market. There's no day traders anymore, people. There are no more day traders, so we're not seeing the pops in stocks anymore that we used to.
So that sounds like, Don, there could be a lot of further potential to the upside when and if that retail investor gets in with both feet. What do you see?
Well, we see that the market's pretty reasonably valued right here. There's definitely room to run. This market, if money starts flowing in, is really going to pop. The economy's better than we thought it was all last year. The analysts keep driving down the expectations, but the economy and corporate earnings start to look really good. Fourth quarter reversed the negative trend that we had from second and third quarter. So we think the market's got room to run, but typically investors get in as the market gets fully valued, and they get caught in that trap where they buy high and sell low, and we think that they have to be careful this time as the markets start to move ahead of the fundamentals and pricing gets too generous.
Does that mean you would be selling into this rally right here?
No, we wouldn't be selling into the rally, but I'd be really aware that the market should take a breather at some point in time, and the higher it goes without taking that breather, the bigger the decline is going to be on the other side.
How big a decline do you think that could be?
I think it's going to be somewhere between 10 and 15%, and as we continue to climb, we're going to see, valuations come down. A lot of stocks, we're having trouble finding stocks that are great values still. I think that the really interesting thing is this activism that's going on about releasing these huge cash hoards that companies have.
Right.
And the sweet spot for us is dividends, and we think that a lot of money is going to come back to investors on the dividend side with large one-time payments and significant increases.
To Rick Santelli, how do you read the mood of this market right now, Rick, especially bearing in mind that the volatility index, the fear indicator, the great market hedge that you guys trade there in Chicago is down to a 6-year low right now? They're really trimming that hedge back right now.
Well, people feel that they're Kevlar protected. Why buy life insurance if you believe that your health has never before been better, thanks in large part to some Fed programs and in some small part to an actual growing economy? So, yeah, nobody's buying insurance. And all these great things about stocks are indeed true, but contemplate this. If you look at a chart today, 207 was our high yield on 10s. We might eke out a new high close here at 206. The current high close back to April is 2.04. We haven't been above 2.5% on a closing basis since August of 2011. We haven't been above 3% on a closing basis since early summer of 2011. So the real issue is, as much as everybody's enamored with this, if instantly we're at 3%, how would all the metrics instantly change on how good equities look?
Would that be big
Well, because,
competition for
Rick,
equities?
we've got 35% higher profits, Rick.
Hang on, Lee. Danny, do you think that would be big competition if the yields got that high?
Well, corporations still have a tremendous amount of money, and they still have to deploy that money in one form or another. So dividends have been on the increase. We've seen a lot of stock buybacks as well, but corporations aren't putting people to work anymore. And I do think that is what people are waiting for. People are waiting to see those jobs numbers increase before they get into the market.
Go ahead, Lee.
Well, first of all, that last point, if you wait until everybody's fully employed and we get down to 4% or lower, that's when the market's going to be fully overpriced. And I would say that, to Rick's point there, there's no other game in town in stock, but stocks earn a lot, and we have 35% higher corporate profits than we did back in 2007. So just because retail investors are buying right now, I don't think it means that the market's overvalued or that they're stupid or wrong. I think it's because people are starting to realize we have a third more profits. And as long as when you say we have one job and you have 200 resumes, no inflation, no wage inflation, it's a good place.
When you have stocks that are yielding more than the 10-year Treasury, stocks have room to run. Dividend yields are on the S&P about 2.2%, and so we think that the market's got some leg here.
So Lee, you're the most cautious on this panel. How significant a sell-off are you expecting over the near term? In addition with you, Don, I guess 15%, you said.
Well, I'm not thinking that we're going to see quite 10 or 15%, though if it happened, I'd be happy. What I think investors need to know right now is I have cash. I don't want to buy the Dow or the S&P. I would look to some place like emerging markets, which haven't had quite the run. They're still doing well, to deploy some capital now. So what investors out there need to do with cash is say, if I need to get invested right now, know what I want to buy. U.S., emerging markets, for instance, but buy the thing that hasn't had quite the run up. And I would say if you look at emerging markets last 2 months, they haven't been quite as wonderful as the U.S. But just don't forget to buy the U.S. if we get a little dip.
All right.
Just want to point out, Bill,
yes,
45 S&P 500 companies have more than doubled in value just since the index's closing high of 1565, and that was reached October 9, 2007.
That's
Netflix, Priceline, Perigo, Ross Stores, Edwards Life Sciences, all from Rich Peterson at S&P Capital.
They have doubled in price. We'll repeat that again. Thank you all. Good to see you. Thanks for joining us today.